world economy has shown quite some resilience since the beginning of the year. Yes, the US economy contracted in the first quarter, but this is expected to reverse in the second quarter, as most of this was due to companies front-running the expected tariffs. Other economies grew actually at a reasonable clip, and the Eurozone surprised to the upside. Nevertheless, we are facing a world of great uncertainties. When the US announced wide-ranging tariffs on most of its trading partners is emblematic for the very different view that this administration takes on the world. Tariffs are not going to go away, and since they are a central part of this administration's economic program. Investors in this context were actually surprisingly calm, with the exception of the response to the initial tariffs when the US S&P index lost more than 12% in less than 2 days. Investors actually took these changes in their stride to a point where many thought these were signs of complacency. We don't think so. We think actually investors are acutely aware of what is going on and are adapting to the sea change in the global economy. One example is obviously the great flows into European assets, especially European equities. But the major indication of this sea change is the decline of the US dollar, which lost more than 10% on a trade-weighted basis since the beginning of the year. This is a clear sign that global investors have started to question the role of the US as the guarantor of the global financial system and of the US dollar as the main reserve currency of the global financial system. As we enter now the second half of the year, tariffs will be right back on top of the agenda. The 90-day stay that was announced in April is about to lapse, and maybe there will be some extension into September, but in the next few weeks or months, we will know the tariffs that the US will levy on exports to its shores. This will create some volatility, but also create some more additional certainty for companies and investors alike. At the same time, we're in the middle of the process of the US budget. That will also create most certainly some volatility, but again, over the medium term, give us a little bit more clarity where the US is heading. We do not think that this will derail the trajectory of either the US economy or the global economy as a whole in the second half of the year. When it comes to growth, we actually expect this growth to continue, probably a bit more lower in the US, but very importantly, we do not expect a recession in the US. The debt sustainability issue will occasionally come back as well, but we don't think it will be a market event that will derail the continuation of the global expansion. Over the course of the summer, sufficient data should become available for the Fed to resume its easing cycle. The Fed will focus more on the softening data that we'll receive from the labor market and will look through some upward pressure on prices as a result of the tariffs. Other central banks will also continue to ease their monetary setting, including the Bank of England and later in the year, the ECB. Investors will have also to look elsewhere, such as Europe, where growth will stabilize, and emerging markets, which offer a great number of opportunities at much more attractive valuations. Lower growth, but also lower interest rates and contained inflation pressure will also be supportive for fixed income markets. We expect one theme to continue in the second half of the year, and this is a weakness of the US dollar. While the US government does not have an explicit weak dollar policy, it clearly seeks to have a weaker currency that may also help it to address its external imbalances. The Fed, for its part, will focus on rates and basically ignore the US dollar. Now, where does this leave investors? There's still continuing high levels of uncertainty demands from our side 2 types of responses, which are actually the 2 sides of the same coin. It's risk management and diversification. When it comes to risk management, investors really need to address in particular their exposure to the US dollar. which is, as we said before, expected to continue to depreciate. Beyond other major currencies, we think that gold will continue to be a good hedge against future US dollar weakness, and beyond that, as recent events have shown, also a good hedge against geopolitical risks. Moreover, as long as the US does not embark on any kind of meaningful fiscal consolidation, we think that gold is also a good asset to hedge against the risks of debt monetization, or frankly speaking, printing of money by the US Fed. Investors will also need to have material exposure to equities, a real asset which can compensate for a world of potentially higher costs and potentially also somewhat higher inflation, as central banks may be willing to tolerate a slightly more inflation in order to help their sovereigns to deal with the growing debt burden. However, it is important to have exposure to equities in a form where one can dynamically adjust the exposure, and hence investors should look for solutions that have the ability to manage the risk by using derivatives. The other element which applies also to equity markets is diversification. Yes, the US will continue to be a main driver of global equity returns, but investors, as they've already started to do so, need to add exposure in Europe and in emerging markets due to their domestic growth drivers and also their attractive valuations. In fixed income, we think that the glory days of short-term money market investments are about to end as central banks continue to ease their policy. As a result, yield-seeking investors will tend to look for lower quality and longer durations to meet their return expectations. Here we caution against extending duration too much, because we fear that the term premium is about to return. Term premium is, in plain English, the compensation that investors demand for lending money for longer maturities. Given the ballooning debt of sovereigns, not just in the US, but elsewhere in the developed world, this term premium risks to rise, and hence we think the best place to be for an investor in terms of duration is in the 5 to 7 year space. When it comes to quality, we continue to propose investing in high-grade bonds. We don't think it warrants to go into high yield, given that we can earn 5% and more in high-quality bonds. The same applies to emerging markets. And our final message is that it's time in the market that matters for investors, not market timing. Choose a strategy that fits your return expectations and your other requirements, and then stick with it. Portfolios are a bit like a bar of soap. The more you touch them, the more they tend to become small.